What's up, everybody? My name is Meet Kevin, and today we're going to talk about mortgage insurance, loans that get sold to you with no mortgage insurance, and how those can be a scam. And we'll talk a little bit about that 20% down belief that you are not ready to buy a house if you don't have 20% down.
And heads up, these two topics might initially sound familiar to you, and you're like, how could these be scams? But if you leave, you're the one missing out on perspective that makes you money.
Just so you know, for perspective, I am a 27-year-old real estate broker, and no, I'm not just trying to sell you a house, although I've sold hundreds of people property over the last 10 years of doing this, but I'm also a real estate investor, and I've built a portfolio from a measly $8,000 to $6 million over my years of investing. There's a lot more info regarding all of this in the links down below, but let's see what we can share right here, right now. So let's just start from the top. Let's talk about why people put 20% down on a house and why people think unless you have 20% down, you shouldn't be buying real estate. Then let's talk about the scam that comes out of this, that is no mortgage insurance loans, despite not putting 20% down. And we'll go into a little bit more detail in terms of how you can build wealth. So first things first, if you want to buy a condo, a townhouse, a house, a duplex, triplex, or fourplex, you can get a loan with 20% down and have no extra fees other than that principal and interest. This is typically referred to as your conventional style financing, and you don't have to pay any mortgage insurance. Let's say you could get that at 4%. Fixed for 30 years. In America, the 30-year fixed rate loan is essentially subsidized by the government, which lets you really take advantage of a pretty dang safe form of financing that, as long as you can make that payment, or you could have a tenant make that payment for you, you'll never ever have to give that house back. Now, a beautiful thing about America is you can also put down less than 20%. In fact, you could put down 3%, 5%, 10%, 15%, or you could even do special kinds of loans, like an FHA loan, where you put 3.5% down. The problem is, any of these loans that you're getting where you're putting less than 20% down require you pay something called mortgage insurance. Sometimes that's called PMI, private mortgage insurance, and sometimes it's called MIP, mortgage insurance premium. It just depends on the type of loan you're getting. This mortgage insurance is basically an extra fee. For example, if you put down 5%, you might have to pay mortgage insurance of somewhere around 0.9%. And you could figure out what that means to you by basically just adding it to your interest rate. It's a little bit of a different calculation, but it pretty much nets out the same thing. So if you're getting a 4% rate with 20% down, but now you decide to put 5%, you're getting that 4% rate, you're really paying 4.9% because of mortgage insurance. That upsets a lot of people because a lot of people see, wow, I'm paying that extra 0.9% for 30 years. That's going to grow to be a lot of money. And I totally get that. Now, with conventional style loans, the cost of mortgage insurance does go down as you put more money down. So for example, if you put 3% down, you might be paying in excess of 1% for mortgage insurance. You put down 10%, you might be closer to 0.55%, or heck, you put down 15%, who knows, you could be closer to 0.35%. These numbers are always shifting and kind of changing, so I'm giving you ballparks of what I've actually seen clients get. I'm sure there are charts and formulas you could look up online. But the goal here is to teach you where the scam is. So let's say you're interested in buying real estate, and you're like, you know what, I want to buy a duplex. I want to rent out the other unit and have the tenant help me pay my rent. I want to buy a 4-bedroom house, and I'm going to rent out 3 bedrooms, and I'm going to house hack this thing. But you're bummed because you know what? In order to get into your first house, you're going to have to pay mortgage insurance because maybe you have the income to qualify for the loan, which realistically, thanks to new laws and stuff, you wouldn't get qualified unless you had the income to qualify for the loan anyway. So you could qualify for the loan. We got that. It doesn't matter what you're putting down if you can qualify. But what upsets so many people is, well, dang it, if I don't put that 20% down payment down, I gotta pay that mortgage insurance. And so that opens up the door to a couple things that people do. And both of these are really, really bad ideas. The first one we're gonna talk about is something called a no mortgage insurance loan despite putting 5, 10, or 15% down. This is where you're like, wait a minute, I'm only putting 5% down and I don't have to get mortgage insurance? That's amazing. It's a great way to trick millennials into thinking they're actually getting ahead when they're really getting scammed. And the second thing people do is they just don't end up buying real estate. Well, what happens if I put 5% down and then the market falls 5%? Then I'm upside down. Oh my gosh, what am I gonna do? Well, let's go ahead and answer the scam of both of these scenarios, because all both of these scenarios are doing is ripping people like you off, which really isn't fair to you because you're probably being misinformed. So let's fill you in. All right, number one, the scam of the no mortgage insurance product when you're putting less than 20% down. Here's the scoop. When you get a loan, you usually ask your lender, hey, what interest rate can I get? And they'll tell you something like, you could get 4%. And then you call somebody else and they go, well, I could give you 4.25%. And then you go, ooh, well, I guess I'll stick with the guy who's giving me 4%. I shop for a loan. I know what I'm doing. It's actually much more complicated than that because there are really three things that go into your loan. There's the interest rate you're getting quoted. Then you have the discount points, which 1 point is 1% of the loan amount. That's how much you're paying to get that interest rate. And then you actually have the lender fees, like underwriting and processing and all that. You really got to know these three variables to properly shop for loans. But that is a topic for really a different video. But you have to know one piece of this puzzle. If you compare two lenders, and one of them is offering you a 4% loan with no mortgage insurance, and the other person is offering you a 4% loan with mortgage insurance, then it sounds like the one with 4% and no mortgage insurance is a much better deal, right? Well, this is where you have to ask yourself, what are the points? And the easiest way to do this, the simplest way to solve this scam is ask your lender, what is the 0-point rate for both of these options? And then you might find, oh, well, if you don't want to pay any points, you're going to be at 4.5% with no mortgage insurance, or 4% with mortgage insurance. And so now you start realizing, wait a minute. So over here, I'm paying mortgage insurance separately from my 4% interest rate, but I'm still paying like 0.8%, so it's still more than 0.5%. But over here, I'm paying 4.5% and no mortgage insurance. Well, that's still a better deal, right? That's where the scam is. That's what they make you think. And that's how you get locked into the scam. Because here's the missing variable. When you buy real estate and you get mortgage insurance, you have this 4% rate that you're locking in. You put 5% down and you've got your mortgage insurance that you're paying. As soon as you get to the position of having a wealth in that property of 20% because the market went up in value, or you paid down the loan, usually to 80%, depending on if you live there or not, and you've had the loan for 2 years, you could actually get rid of your mortgage insurance. Now, you might have to pay for an appraisal to justify the value, but watch this. Here you are making a 30-year decision going, should I take the 4.5 rate with no mortgage insurance, or should I take the 4.0 rate with 0.8% in mortgage insurance? Most people are going, give me the 4.5, that's better. But wait a minute, you locked that 4.5 in for 30 years unless you refinance. Over here with the private mortgage insurance, sure, you could refinance out of that as well if you want to get a new loan. But once you get to 20% equity in 2 years, you pick up the phone and go, I want to order an appraisal to get rid of my mortgage insurance. You could get rid of that mortgage insurance as soon as 2 years after buying a property. So now the real comparison is, do you want to pay 4.8% for 2 years and 4% for 28 years? Or do you want to pay 4.5% for the entire 30 years? Do the compound interest math on that, and I think the answer becomes very clear. See, if I ever put down less than 20%, I would always take mortgage insurance because I know I could get rid of mortgage insurance. But don't think you're lucking into a free lunch because you're getting a no mortgage insurance loan. You should know there ain't no such thing as a free lunch. The lender's making their money one way or the other. And it's usually because people aren't comparing 0-point options. Quick clarification on that, the lender might say, hey, 4% no mortgage insurance, or 4% with mortgage insurance. And then they tell you, oh yeah, but you have to pay $4,000 or 2 points or whatever to make that happen. And this is where the math gets really complicated. And this we're not going to go into in this video. It's so niche. I have spreadsheets that solve this in the real estate investing course link down below. I teach people how to do the math on this. It is a little tricky though, so we'll save that for a different place other than YouTube. Let's now get into the scam of 20% down, which is what kind of started this whole mortgage insurance predicament anyway. I strongly believe that if you're saying to yourself, I'm just going to wait to buy real estate until I have 20% down, yet you have the income to qualify for a loan, you're probably making a mistake. Here's why. Let's say you bought a $400,000 property that was new construction. Cool. After you move in, you probably have a property that's going to be worth like $390,000. New construction can lose a little bit of value right after you move in, but you do get things like builder warranties and that, which is kind of cool. But here's an alternative scenario for you, since in this case you're probably going to be stuck with mortgage insurance a little bit longer. Let's say you want a house that's going to be worth $400,000. So you buy a house that's worth $300,000. It's a fixer-upper, and you're going to put 5% down. That means you're putting 15 into the deal. Now you have some spare time, so you're going to put your labor in, you're going to fix up the property. You're going to do some painting and some basic drywall work, and you're going to do a little bit of basic construction because you've got extra time and you're willing to work to build some extra wealth. Now, where a contractor might have to spend $50,000 renovating this property, you spend just $20,000. That means you're out of pocket $35,000 buying this $300,000 house with just 5% down. But now the property is worth $400,000 after you fixed it up. See, the new construction guy bought a house for $400,000, but it's worth like $390,000. You just bought a house for $300,000 that's worth $4,000 after you spent a little bit of money and time fixing it up. Now all of a sudden you're like, oh, what can I do now? Well, let's see. You put 15% down on your $300,000 loan, so you only owe $285,000. Now you go to the bank and you refinance and you go, hey, I got a place that's worth $4,000. The bank goes, cool, what do you owe? I owe $285,000. Great, looks like you've got about 23% equity. Let's refinance you with no mortgage insurance. And see, there you go. This is the second reason mortgage insurance is a scam. When you realize that, wait a minute, I could go shop for deals with 5% down, get a fixer, fix it up, and then end up with 20% equity, get a new loan 6 months later, boom, I don't got no mortgage insurance anymore. You don't even have to wait 2 years anymore now. And getting a good deal insulates you in the market way more, so you don't have to worry about that feeling of, oh, well, what if the market goes down 5%? Then I'm upside down. Well, first of all, you should never be selling your real estate. You should be holding your real estate for the long term. Talk to me in 27.5 years, and then we'll talk about other options. But in the meantime, make sure to smash that subscribe button, follow me on Instagram, and check out the courses linked below. I'm getting kicked out of this lounge now.